Hey soldiers, let's talk about how to make some money using a particular asset that is an asset favored by large banking institutions, corporations, and the uber wealthy here in America and abroad. It's kind of a stealth wealth secret, best kept secret kind of thing. We'll get into it and show you how it works in some ways. Now, we're not going to go into great depth because this video is an example of what we're offering over in the members section of the Soldiers of Finance platform here on YouTube. We call it the Officers Club. Now, what we do over there is we take detailed looks at asset classes and we break it down. We're into section 3 of how the stock market works, okay? And we're moving forward with detailing that. There are assessments that we actually provide to help you learn and internalize this very valuable information. So I want you to understand what this is. I'm sending this out to the general Soldiers of Finance audience. And those of you who may not have subscribed yet, go ahead. All you got to do to enlist is hit that subscribe button. All right. And on a daily basis, right here on the main YouTube platform, we're putting out some very valuable information about the rapidly evolving global economy and your place in it. You want to take a deeper dive, and I suggest you do, because these days you are solely responsible for your financial situation. Okay. Social Security is not something you're going to be able to count on. Your 401k is good, but remember the tax man cometh. He's going to want a piece of that. All right. So always have that in mind when you look at that balance. But the Soldiers of Finance platform, if you go ahead and subscribe and then you take it a step further and join our membership, hit that join button if you want to find out more about all of the things we offer. Now we're going to jump right into it. By the way, hit that thumbs up. That helps to spread this message. Ladies and gentlemen, I am on a crusade, okay, literally. And you might chuckle when I say this. I'm being absolutely serious. I feel as though I am on a mission from God with regard to talking to people about financial independence. And one of the reasons why I believe that's the case is because if you look at the world, let's just look at the economy. Let's not look at any other factor of the culture right now. Let's just look at the economy. We've got things like artificial intelligence that's going to take 300 million jobs off the table in just a few short years, okay? We've got rising inflation. We've got a rising national debt, which will lead to rising taxation, okay? These are all things that are putting pressure on your ability not only to enjoy your life, but to pass on wealth to future generations. So let's get started. The way we're going to do that is talking about my personal philosophy. Now, again, I want to stress that's my philosophy. I'm not giving you financial advice because this is a general conversation. And in order to provide advice, I would need to actually sit down with you live or over Zoom, and do a lot of analysis before I did something like advise you personally. So this is my philosophy. And let me explain one thing about my philosophy, and then we'll get started with the meat and potatoes. My philosophy says, Tyrone, you want your family to be able to prosper and to maintain economic independence no matter what happens, okay? So if the dollar does go into a situation where it loses reserve currency status, we've got the type of assets that, when we focus on the type of assets that will hold us in good stead if that happens. If we go into a new golden age, okay, and it's economic prosperity throughout the world like we've never seen before, well, in that case, we're in good economic stead. So you take both of those spectrums and everything in between. That is how I focus my philosophy so that it's a win-win-win no matter what. Okay, so just keep that in mind. All right, so diving a little deeper here. The mechanics of my philosophy are predicated upon two major pillars. Number one, purchase assets that provide income and appreciation. Okay, so we want to see the value of the asset increase, and we want to get some income from that asset if we can. Now, all assets don't kick off income. There are some stocks, for example, that don't pay a dividend, but those stocks do, have a history of appreciation in value. Okay, so you are doing better, hopefully, than you did when you bought it in terms of the value of that asset. Okay, so those are the two things. Now, the income piece also enables you to perpetuate your lifestyle. Look, this is not just about saving every penny and clipping coupons. No, this is about doing what we see wealthy people do. Now, there is a component of this that will call for an individual to shy away from conspicuous consumerism. No, we're not going to go out there and buy the latest and greatest vehicle. No, ladies, you're not buying, or guys, even, it's 2023, not going out there and buying the latest red bottom shoes, okay, that cost a fortune, or these handbags that cost thousands of dollars, and people walk the streets with an expensive handbag and no money to put it in. To put in it, rather, okay, which is insane. All right, so what we're doing is we're not buying liabilities in my philosophy. And when I say we, of course, I'm talking about my family. We're not purchasing liabilities. Now, you might say, well, Tyrone, you drive a car. Yeah, we do. That's a necessity. But we also have a real estate organization that the car is put to good use, helping us to make money. Now, I'm certainly not suggesting that every aspect of your life has to kick off income or appreciate in value. Your life in general should appreciate in value based on your experiences. Those experiences could be having the money to take the kids to, Disney World or whatever it is that you all want to do, or going on a cruise, or affording a college education, or being, looking at your daughter and saying, hey, you've done well, you're getting married, we're going to give you a down payment on a house, or we're going to pay for your wedding, or something like that. So those also are invaluable. You cannot replace these quality experiences with family, right? But in order to do all the things I just mentioned, you do need some money. So that's where that income piece comes in. The other thing that income allows you to do is purchase more assets. Now, some of those purchases can be put on autopilot, dividend reinvestment, for example, okay? Some would have to be, you'd have to take a more proactive approach. If you're getting rent from a property, sure, you have to go out and identify more properties to purchase or improvements to put into that property in order to raise the rent, so on and so forth. Okay, so purchasing assets that appreciate and or kick off an income. Now, you don't want to sell assets. That's another place where income comes into play. And we'll get to my second, pillar of the philosophy in a moment. You don't want to sell assets. You want to keep those assets in play, appreciating in value, kicking off income. Again, that income is going to do two things for you. It's going to allow you to have a quality lifestyle, and it's going to allow you to buy more assets, okay? So you might say, well, Tyrone, how's that going to work? I mean, you're talking about increasing my lifestyle, increasing the amount of assets that I buy. Well, this brings me to the second pillar, setting up multiple streams of income. Ladies and gentlemen, it is 2023. If you do not have multiple streams of income, you are hustling backwards. Many people that work for a living, they work a W-2 job. Let's take some of the people out I know someone who works at Meta, formerly Facebook. They call it Meta now. And this individual, for the past 6 months, has been threatened with layoffs. We're laying off 10,000 people. We're laying off 20,000 people. So it's musical chairs. Who wants to live that, right? Who wants to live that existence? Will there be a chair for me when the music stops? Well, you won't have to worry as much about that if you set up multiple streams of income, all right? And you have a certain percentage of your lifestyle, your mortgage, your food bill, okay, care for the kids, okay, a certain percentage that is coming from those incomes, and then a certain percentage that is allowing you to go back and put money into more assets. Okay, so what have we got? We got purchasing assets, not liabilities, if you can help it. Look, I know the car market has been weird for the past few years, but with regard to purchasing a vehicle, let somebody else get the bulk of the depreciation, bite the bullet, go out, and if it makes economic sense, look at a pre-owned vehicle where a lot of that depreciation is already shaved off. That's optimal. Again, I know the car market has been in flux since 2020, supply problems and whatnot. Minimize your exposure to high dollar liabilities. Okay. All right. So moving on. Now we talked about the asset acquisition, being very judicious about liabilities. We also talked about additional sources of income. Okay. Building those. Let's talk about one source of income that happens to appreciate. This is an asset that we're talking about now. Now, it is an asset that, let me talk to you about the credibility of this asset first. Okay, if you look at this chart, we see that this is a chart of banks that own life insurance. Okay, banks. And these aren't just any banks. You see, we've got Bank of America, JP Morgan. Okay, these are the large banking institutions. And you might wonder, well, why do they own life insurance? It's because banks do not put their money in a savings account. They don't put JP Morgan, no one runs downstairs and says, hey, we just made $1 million, put it over in the savings account that we offer. They don't do that. And the reason they don't do that is because the way a bank is structured and how it works. And listen, banks are they have a phenomenal business model. The business model says you put X amount of dollars, let's just say $10,000, into an account. And they say, we will keep this money safe for you, up to $250,000. You're guaranteed by the FDIC. So you put in the $10,000. They're going to keep it safe for you. But what they're going to do is pay you, at this point, 0.23 percentage points in terms of interest. Your money is not even getting out of bed in the morning, okay, let alone working for you at such a percentage rate. And that is the average for brick and mortar banking here in the United States. Today, it is the 10th of June, 2023. Okay, you can see here, we deposit $10,000 initially. This particular calculator will not allow us to do 0 in the monthly contribution column. So we'll do $1 per month contribution, make it as close to 0 as possible, over a period of 10 years at an APY of 0.23%, which again, right now is the prevailing brick and mortar rate. We're going to have $10,353. So over the course of a decade, you made a whopping $353. And let's just be honest about it. And 77 cents. Whoop-de-doo, right? All right, but even with that, you can say, hey, well, I made money. Okay, but did you? Now let's take a look at the effect of inflation on that amount. All right, so the impact of inflation on that $10,353.77 over the course of a decade, and we're going to take inflation down to 2.5%. Now, that is being very, very generous because we all know that inflation over the past few years has been a lot higher than that. But let's just average it out at 2.5% over the decade. And now your $10,353.77 actually spends like $8,088.35 10 years later. So you've lost, you've lost $2,300 roughly. Okay. How's that sound for the reason why banks do not put their money in their own savings products? Because they know that's not the way to grow money. Okay. Should you have a bank account? I think that from the standpoint of transacting bill payments and things like that and having a little bit of liquid money at the ready in case you need to address an emergency or, grab an opportunity, for example. Maybe you see something on sale that you need. You want to jump at it. I get it. You want to save 10%. All right, fine. But to have an inordinate amount of money in a bank in 2023 at 0.23%, and you might say, well, I'll just put it in an online bank. And you will get better rates. You're up in the neighborhood of 3.5% at that point. But remember, inflation over the last few years has been a lot higher than 3.5%. In fact, if you account for real inflation, and what I mean by real inflation is inflation that is calculated in terms of how we calculated it back in the 80s. If we're calculating it based on that and not, doing it in such a way that is politically pleasing to both sides of the aisle, okay? They want to report the lowest number possible. So they have reconfigured how they calculate that rate. But real inflation has been as high as 17%. And we look at John Williams' shadow stats in order to substantiate that number, okay? So even with the online banks, you're not coming anywhere close. So your money is actually not working hard enough to keep you treading water, let alone swimming, okay? You're underwater, and that's not somewhere you want to be. So this is one of the reasons why very wealthy families have always had life insurance as a component of their particular asset portfolio, all right? The Kennedys, the Rockefellers. It is a well-known fact that these families have perpetuated their money, in the case of the Rockefellers, over a century. In the case of the Kennedys, they're just around a century, okay, of generational wealth. And now let me explain to you also, one of the assets they had was their own business. That helped tremendously in being able to grow their income because they didn't have to walk into an office and ask a boss for a raise. And if you got it, do you think your boss is going to give you a 17% raise to equal the inflation that we've seen in the past few years? Absolutely not. All right. But it is highly possible. In fact, the Small Business Administration has data that substantiates that a small business that is well managed and in a competitive field, something someone needs, is going to return on average between 15 and 30%. Now that will beat inflation. That business will serve as an asset, and the more you invest in that asset, time, resources, it will appreciate in value. And of course, what are we in business for? To kick off an income. So I just want to point that out. The Rockefellers, the Kennedys, there's so many examples that I can give you. Use life insurance as a tool. And there are a lot of people that do that today. We saw the chart with the banks and how they are actively using life insurance. You will not find JP Morgan, Wells Fargo, Bank of America, Fulton Bank, on and on and on. You will not find, from the biggest to the smallest, you're not finding any of them putting their money in their own savings products. Okay, so Bank of America, over $24 billion in bank-owned life insurance. JP Morgan, over 19 billion, almost said million, billion with a B, dollars in bank-owned life insurance, yet not one penny in their own savings products. All right? All right, so let me just address one more thing about insurance, because that is all assets cost money, okay? Somewhere along the line, people started to believe that the cost of insurance was something that was an anathema, something that they should not be expected to pay. There's a cost of insurance. Yes, there is a cost of insurance. We just showed you the cost of a savings account. All right. Put your money in a brokerage. There are going to be fees associated with that. You can put your money under your mattress. And how much do you think you'll lose then? You won't even do as well as the $353 you made on the savings account. That's a 0% interest gain when you keep it under your mattress. Everywhere you put money, there is going to be a cost associated with that. However, and we're just talking about one asset class here. I'm not suggesting that all your money go into any one basket, okay? I'm telling you, because I certainly don't do that, all right? And again, I'm stressing what my philosophy is. Now, with an insurance policy, You also get things that a bank cannot provide, or chooses not to provide. Well, they can't provide it. They can't provide the tax incentives that an insurance policy provides. You put your money in a bank. If you make interest on that money's going to be taxed. Okay, let's take it one at a time. If you put your money in a insurance policy, your money is going to be allowed to grow tax-free. Why is your money allowed to grow tax-free in an insurance policy? Well, because IRC, or Internal Revenue Code 72E, this is the rule book of the IRS. This is another thing that you need to understand. The IRS doesn't have to be your enemy. There's a ton of provisions within the Internal Revenue Code that allow you to build wealth, actually promote the construction and maintenance of wealth. Certain socioeconomic classes in this country have been taught, programmed to see the IRS as nothing more than adversarial, to be terrified of them, when in fact the wealthy understand that they're in that IRC code, in that Internal Revenue Code, in that rule book, there is a plethora of opportunities for you to build wealth. Internal Revenue Code 72E is one of those. It allows you to build wealth, to have that money accumulate, and do so without interruption or interference from taxation. That's their rules, not mine. Going further, Internal Revenue Code 7702 allows money in the insurance policy. And we're talking about permanent insurance policy. We're not talking about term. You hear it on the radio. Oh, you can get $1 million of insurance for $30. Okay, we're talking about an asset. We're not talking about renting your wealth. Okay, so 7702 allows you to actually access that money tax-free if you do it correctly. Okay, and the Carnegies, the Kennedys, the Rockefellers, on and on and on, have been doing it correctly for many, many years. Then Internal Revenue Code 101A allows you to pass that money on to your heirs without taxation. It's very powerful, okay? So people in America should not complain, oh, the rich are able to do this, they're able to do that, and I don't have an opportunity. Well, as far as the IRS goes, you do. Those rules are not written exclusively for rich people. They're written for everyone, okay? Rich people write the rules. That's true. Because, of course, they want to advantage themselves, all right? Okay, fine, whatever. But as long as I can take advantage of that too, that is certainly what I'll do. So that is just some of the mechanics of the permanent life insurance policy and how it helps you to build wealth. You can link these policies to indexes such as the S&P 500. And you want to talk about return? Well, the S&P 500 has returned on average 10% for the past 20 years and beyond. Okay, so you want to talk about return? There's some return. You know, these policies also have built-in ceilings and floors. So when the markets dive, you don't go down to the basement. You stop at the first floor. Okay, and we can get into that in other lessons on this topic. But if you want more on this, and we are going to do a lot more on this asset class, then I encourage you to go ahead and hit that join button and learn what we have to offer here at the Officers Club, the members section of the Soldiers of Finance platform here on YouTube. Guys, I'll talk to you soon.